Hey guys, I'm Duncan Wilson.
And I'm Sasha Syed, and you're listening to the Mortgage Sweet Spot Podcast, proudly presented to you by Mortgage Suite.
This podcast is your go-to source for expert insights, innovative strategies, and the latest mortgage trends to help you make the most informed decision regarding your mortgage financing. Whether you're a first-time home buyer, a seasoned real estate investor, or maybe somewhere in between, you've come to the right spot.
So sit back, relax, and get ready to discover your mortgage sweet spot.
What's up, guys? We are talking about the self-employed borrower. And what does that mean? Are you a sole prop or are you incorporated? Are you getting a T4 from an employer? Are you taxed at source? Or do you just get paid for whatever you do and then you pay taxes at the end of the year? Are you writing stuff off or are you not writing anything off? Those are some questions and stuff that we're going to address today. So, Alex, talk to me about self-employed borrowers.
All right, sounds good. Well, there's many ways to make income in this beautiful country of ours. Some people take that into their own hands by starting their own business, and there's several different structures that you can do this in. As far as your ownership structures, you can be a sole prop, and that's where you register a master business license, and you are the only owner of your corporation. Your business income is taxed personally, so you will have a statement of small business activities on your T1 General. And that's where you would calculate all of the income that you collected for your sole proprietorship, and you deduct all of the expenses associated with that business, and then you're left with a net business income, and that is taxed at your personal tax rate depending on where you are and how much money you made. Alternatively, there's a partnership, which is like that, but you split it in half or maybe split it 3 ways with several different partners. And then there is corporate income, and that's where you establish a corporation, you register your articles, and your corporation is what is collecting the income whenever you do your services. So if you're a car cleaner, for instance, all of your bills that you collect for your services go into the corporation, and then you pay yourself as an employee out of that corporation. You can be a direct employee and you pay yourself a T4. You can pay yourself as the owner via T5 dividends. There's different tax advantages for doing either or. And that is how you would structure it that way. Without getting too deep into liability, the main benefit of setting it up as a corporation from a liability standpoint is you're a limited liability corporation. Anything that, any debts incurred as a business are the business's debts. They're not your personal debts, as long as you're not co-signing personally. And if you're a sole prop or a partnership, those are not limited liability partnerships. You would have sole liability for any debts incurred under that business. So if I am an independent contractor, maybe I'm a framer and I got a truck loan and something goes wrong and I can't pay the truck loan, that falls on your personal liability as opposed to the corporate liability.
Yeah. So like if you are sole prop, you can be sued personally. If you're incorporated, they sue the corp, nothing happens to you personally. Simple terms.
Yeah.
But what does that mean for getting a mortgage? So in the prime space, they're looking at your net business income or your statement of business activities. Typically, they're using a 2-year average of that net income, and then they're grossing it up by 15%?
Yeah, more or less. They're just trying to establish consistency in how you pay yourself, because as a sole proprietor or as an independent business owner, there are naturally going to be some more variabilities in your income just because you're not being paid by a bigger corporation that's paying you a base salary. So it's hard to project your income. So the best way to project your future income is to look at your past. Ideally, you'd be growing and your income would be increasing or staying steady at the very least on that 2-year average. If it does decrease for the most recent year, so in this case, we're recording this in 2025. So if your 2024 income as a sole prop is going to be lower than your 2023 income, then we are going to have to take your 2024 as is. Sometimes you gross that up by 15%. Whereas if it's growing, say you made $100,000 in 2023 and then $200,000 in 2024, we can take a 2-year average of 150 and then gross that up by 15%.
So that's for the prime space. Sometimes that doesn't work out for you because like us and other self-employed people, you're writing down your income as much as you can. So when you're trying to buy a house, going in at $25,000 in annual income is not really going to get you very much. You might be able to get a shed from Home Depot or something. So what we do is on the B side or in the alt lending space, there is a product that we use called stated income. And this allows us to use your cash flow of the business rather than using your net business income. And the way what that looks like is we get 6 or 12 months in bank statements from the business account. We add up all the deposits. we look for any reoccurring transactions in there that could be expenses, and then we do stated expenses, and then whatever that net income is the amount we'll use on the application. So, for example, construction people are a good, like a good example to use for this. You know, they got materials, you know, they have employees, they're making pretty good money, but they're writing all this down. They're writing off all, you know, all the salary stuff.
Yeah.
And then your income gets to be pretty low at the end. But when you look at the actual cash flow of a construction, you know, contractor's business, there's much there to be had.
Yeah, and the underlying thing there is always going to be reasonability. And that's where we take a look at the feasibility of this mortgage loan that we're getting you. And it's like, okay, does it make sense that we are getting you this $2,000 a month mortgage payment? You know, can you show us in your business cash flow that you are going to have this money, and that push comes to shove, you can pull money out of the business account and put it into your personal account, pay yourself in order to keep up on your mortgage payments. That's a big one. But yeah, another thing too, if you're incorporated or it's in a separate business account, sometimes people like keeping the money in the business because, one, you don't want to tax yourself. If you're incorporated and your business makes $150,000 in net income, and that's going to be taxed at 15% as a corporate income tax. But if you are paying yourself that $150,000, then you're paying a progressively higher income tax bracket, because it's tiered, you know, 25% for the first 50K, 30% for the next. I'm not an accountant, don't know the exact ones, but it does scale up, and you end up paying a lot more in personal income taxes for that $150,000. So the way people get around that is by keeping your business expenses in the corporation, and then you pay yourself out that T4 or that T5 for whatever you actually need for your living expenses. So if you can live off of a budget of, you know, $3,500, $3,000 a year, we'll call it, then you pay yourself $36,000 for that year. And you're only taxed personally for that $36,000. Your business is still taxed. But when we use these stated income programs, and we can do this on the insurance side too, where you only have to put down 10% for your down payment, but we're going to look at the reasonability of you as a self-employed person being able to manage this new debt that we're going to go and get you. And if I take a look at your business financials and I see, well, you know, you got retained earnings every year and it's growing by $50,000, then that tells me you're making an extra $50K in your business, you're keeping the money in the business, you're reinvesting it in it, and it's growing the profits of that business year over year over year. Reasonable that we can pay yourself an extra $50,000 to take on this new mortgage borrowing moving into the future. And that's a way to get around, you know, paying Uncle Sam an excessive amount of income taxes.
For sure. And so, like, another thing to note too, so other self-employed people might be not just on a sole prop or like incorporated, but you could be a contract employee. For example, like us as mortgage agents here, we're contracted through Mortgage Suite. We get paid a T4?
T4A.
Yeah, T4A for commission. Same thing with car salespeople.
Same thing with realtors.
Yeah, same thing with real estate agents, taxi cab drivers, same thing. So, I mean, if you're considered that, then it's the same thing. You want to be writing down your expenses, and we're looking at net business income. But basically, I don't know, does the stated income apply for like commission contract people?
There are some restrictions on it. Unfortunately, we can't get access to it as mortgage brokers for one of the exempt parties. Hairstylists are A-OK on that stuff. Cab drivers would probably be A-OK. There's a full exhaustive list of everything. So we'd have to dig into your personal situation and make sure that it's A-OK. But it's a good way to show that the business income is coming in via your commissions or via your self-employed income in whatever way that you may be earning income. And we can get a little bit extra on top of the standard traditional methods of taking that to your average.
Yeah, so maybe some things to consider if you're, you know, maybe considering doing a stated income product, you know, just keeping your accounts pretty clean and organized, you know, try to keep the main things from the business coming out of that business account. Yeah,
keep the personal expenses out of the business account is definitely a great starting point.
Yeah.
Just your accountant will thank you for doing that as well.
Yeah, keep invoices. Don't throw anything away. That's another thing I find is, you know, some people are not really the best at keeping stuff organized, but if you got all that stuff, it just makes for a much easier process. Statement of account is very important as well. Self-employed borrowers, if you're carrying your income tax balance over the next year and then you want to go apply for a mortgage, that balance does have to be paid before closing. I ran into that a couple of times where there was a balance remaining, and thank goodness they had a financing condition, but very important to keep your taxes paid and up to date.
And just as a general note too, if you're just starting to get into the self-employed space and you're collecting that T4A instead of that T4, make sure that you're planning for the tax bill at the end of the year, because as a salaried employee, or even as a part-time employee where you're getting paid hourly and you see those taxes come off every paycheck, it's obviously it stinks, because you're just seeing the government take a little piece every time. But when you're not having your taxes deducted from those paychecks one little bit at a time, you can end up with a pretty hefty bill at the end of the year that can shock you.
That's true. So yeah, I think what a good general rule of thumb for that is it 30% of each pay you put aside for taxes?
That's a good starting point, yeah, depending on the income that you're bringing in. Another trick and strategy that I always recommend is utilizing your registered savings accounts. So if you're a first-time buyer, the First Home Savings Account is wonderful. It allows you to take that income that you're pulling in from your employment or your self-employment, and you stick it away into this registered account. And it operates like an RRSP, where that's a deduction of your taxable income. To keep it simple, say you are making $50,000 in your T4A or your small business activity income for a given calendar year. But you take that $8,000 limit that you can apply to this FHSA every year, and you contribute your money in there. You're taking money that you earned into your business, you're putting it in this specific account that is there to save away money for a down payment on a property. And instead of the government taxing you on that $50,000, they're only going to be taxing you on $42,000, which at that 25% tax bracket is going to save you about $2,000 in your income taxes. And you can do the same thing with your RRSPs as well. That's a great way to get money out of your business and into your personal savings, to stick away for the long-term savings. It's a great way if, say, you have $400,000 or $500,000 sitting in your business and you're trying to get it out or trying to show income on a mortgage application. You can take that and pull a bunch of money out, dump it into your RRSPs. Is it locked away long-term into your retirement? Yes. So that's something you consider there too, because your money's no longer in your business and you can't use it as flexibly. But you are sticking some funds away in the long-term savings. As long as you're investing it properly, it's going to be growing and aiding you in your long-term financial planning. But it then allows you to pay yourself a lot higher on your personal income taxes from your corporation without incurring that tax liability in that given calendar year. So in this situation, say you normally pay yourself $50,000, but you want to pay yourself $150,000 for the purposes of a mortgage, then you pay yourself $150,000, you take $100,000, dump it into your RRSPs or your First Home Savings accounts. Obviously, restrictions as to what you can do and how much you can do. That's a file by file assessment. But that way, when we look at it on your T1s, you're making $150,000 and not $50,000 in the eyes of the government.
Yeah, some other things just to keep in mind too. Self-employed, prime side, looking for 2 years or more. B side, looking at stated income product. They want a minimum of 1 year. Must have a business license or articles of incorporation to be able to produce. I think
that's it. Something else to consider on the B side. Obviously, if you've been listening to these podcasts, you understand some of these fee structures. B is going to be more expensive. It's far more flexible, but you're probably looking at an extra 0.5% to 1% on your interest rate every year.
Depending on your credit score.
And plus an additional 1% lender fee. And depending on the complexity of your bank statements and how much we have to dig into it, we will also have to charge 1 to 1.5.
That's agreeable.
Yeah, more or less.
It is what it is.
It's a lot of work, but it is very flexible, and it's a wonderful product if you are put in a pinch and you need it. If not, a little bit more planning and developing that 2-year game plan to get you into the AAA and stated income space, I think, is more valuable.
Yeah, absolutely. So if you have any questions, if you're self-employed, you're just getting started, or you've already been self-employed for a while, but you're getting started to look at a property, give us a call. We're pretty well versed in that, but everybody here is pretty good too. So reach out. Somebody's available to answer your questions. And we'd love to help you with that.
100%. I would caveat that we are also not CPAs. This is not tax advice formally. I should say. We can only help you in your planning for getting a mortgage, but we know accountants, and if you need one, let us know.
Yeah, and we'll have an FA, financial advisor, on here soon to give you some more advice about savings accounts and what to do with your money and stuff. So stay tuned.
Brilliant.
All right.
Thanks, Sasha.
Stay classy, Windsor, Ontario.
Ladies and gentlemen borrowers, thanks for tuning in to the Mortgage Sweet Spot. If you have any suggestions for upcoming episodes or questions for our hosts, me and Sasha, throw them in the comments below.
And if you enjoyed the podcast, please subscribe to our channel on your preferred platform. We're available on Spotify, Apple Podcasts, or you can check us out on YouTube. Once again, thank you for tuning in, and we'll see you on the next one.